A very good evening this January the 15th, 2026, a start of a brand new calendar and a financial year. And I know it's a bit belated, but let me wish everyone listening to this, either today or in a recording in the days and weeks to come, a very happy, peaceful and prosperous new year. May it be kind to one and all, and above and beyond that, may it be profitable. So you'll see in the background, I have moved locations. I had the unfortunate desire to actually build and move around the festive period. So I've moved outside of Cape Town. I'm now probably about 186 kilometers away in a place called the Romansbaai Fynbos and Eco Estate, which is just past Gansbaai. And in the office that I had built, because my old one was so small and so stuffed full of papers, which many of you may have seen in previous recordings, I needed more space. So I built myself a much bigger home office. The dog is running around somewhere in the garden. And behind me, for those that perhaps are as old as I am, or even perhaps some younger listeners with a sense of history, is the closing picture of the open trading floor of the Johannesburg Stock Exchange from June the 7th, 1996. That was when the old days of trading shares by open outcry, where bits of paper and prices were chalked up on a board, was all done away with, and we went onto electronic trading. And the days of camaraderie and the market opening at 9 and closing at 1, and we had an hour for lunch, all very civilized. We got back at work at 2 o'clock. The market closed at 4. Then we all settled our trades of the day and then went to the pub and had a beer. So the reason why that picture is behind me is I found this in an antique shop about 2 years ago in Pretoria. Bought it. It's about 2.6 meters long by about 1.2 meters high. And I'm actually on the Anderson, Wilson and Partners pitch, just to one side of a board, watching the closing transactions of the JSE on that day. So I joined the market literally in May 96, and then literally a month and a half later it closed and we all went to our offices, and then we were transferred from the JSE to Standard Bank head office, because I was working at that point for Anderson, Wilson and Partners, an esteemed old name in stockbroking, which was then acquired by Standard Bank to become Standard Equities. So that's the picture behind me. From my perspective, I've got a bit of a sore throat, having had a bit of a chill over the festive period. So if I sound a bit hoarse, please excuse me. My beard is a bit long as well, because I never shave over Christmas. I look a bit like a blonde Santa. And if I take a break every now and again to sip my juice, my apologies. But I'm going to crack right in and give a quick review of my top stocks of 2025, and then move swiftly into why you're all here. The top stocks of 2026, which hopefully will do slightly better than my 2025. But as I said in a radio interview and a television interview earlier this week, given the performance of most of the stocks from last year, I can hold my head up at least outside my office door. So as a reminder for last year, the top 10 were ADvTech, Cashbuilt, Combined Motor Holdings, Grindrod, Hoskins Consolidated Investments, KAL Group, or formerly Carp Agri, Nampak, PPC, Rainbow Chickens, and RFG Group, or Rhodes Foods. Now, in aggregate, the total return last year was 16.15%, versus just over 17% of a point of selection for the JSE Small Cap Index, 26% for Mid Cap Index. But the Aussie last year, the point of selection was up 41%. As I'm sure many would know, last year was dominated on the JSE by the movement in gold shares, platinum shares, and the big mega cap blue chips like Naspers, Prosus, and British American Tobacco. So as I teased some clients last week, if you were only in a handful of stocks last year, you could have put your feet up, done nothing, closed your books, and hopefully made enough money in your performance bonus to sit in your villa in Plett, or your tax-free exile in the Seychelles counting your money. Sadly, in the small to mid-cap universe, I only cover industrial shares. So there are very few mining-related stocks that I actually cover. One I've covered on a consistent basis is Afrimat, and I'll talk about that later. And I also have files, as a matter of interest, on Jubilee Metals and Copper 360. So in last year's selection, despite it being up 16.15%, just shy of my benchmark indices, the small cap index, but well short of a mid cap, the best performing stock was Grindrod, up just over 50%. The second best stock was Nampak, up 33.3%. Then we had Rainbow Chickens, 32.7%. We then had RFG Group at 27%, and most of our stocks actually met or exceeded my varying benchmarks. However, in every selection, you never get everything right. So I can confidently say that 7 out of my top 10 stocks did exceptionally well, and I was proud to actually choose them. One was my nemesis, Cash Built. When I chose it in December 2024, the underlying environment in this country was significantly different. There was ongoing hopes that the GNU after the election of 2024 would keep momentum going. The two-pot retirement system was hopefully going to unleash billions of rands into the economy, which people might spend on consumer goods or renovations or DIY. And for a while that continued. And then into 2025, the two-pot system was shown to be a damp squib. The likes of a Cash Built and Italtile were basically hit by a brick, and the share price of both shares fell quite spectacularly during the course of 2025. If only we had a crystal ball and could predict all of this a month earlier, but we didn't. In the same vein, when President Trump was inaugurated in early January 2025, we had no idea back then that he would unleash total chaos on the global world order, not just in trade policies, but also geopolitics. If you'd said to me or anyone 12 months ago that he'd implement unilateral tariffs willy-nilly against any country of his choosing, much of them made up because he didn't like them, he'd want to start wars in Iran, Venezuela, Cuba, Colombia, even Greenland, you would have thought I was smoking some special tobacco here in the Western Cape. But he did all of that and more. Perhaps as a deflection to the Epstein files, we will never know. But here we are in 2026, and once again, the orange Jesus is causing mental chaos on the global world order. The other two stocks in 2025, which performed initially abysmally, but actually picked up quite nicely, was HCI and KAL Group, or Carp Agri. Now, if I keep calling it Carp Agri, I must apologize. I know the company gets very cross when I keep calling it Carp Agri when it's called KAL, but I've covered the company for 20 years and old habits die hard. Now, HCI had a terrible year. Oil was out of favor, the discount to net asset value widened to over 60%, and the CEO, Johnny Copeland, quite frankly, didn't give a rat's ass sort of stuff what shareholders thought regarding the widening discount or his underlying management of a company. But towards the end of 2025, activists got involved and some saber-rattling and some quite terse statements occurred. And lo and behold, in a flurry of activity in December, HCI basically buys back over 600 million rands worth of shares at 133 rand. They sell off a stake in their Whale Route shopping mall here in Hermanus, near me. And they sold off the Sea Point building in Regent Street for an astronomical sum of 943 million rand. So showing you that inside HCI was lots of assets waiting to be unlocked and sold off. And as I wrote in a note, I remarked that the annual general meeting of HCI foretold all of this in late August, when Johnny Copeland said he would unlock value. We just didn't think he would do it all in a space of a couple of weeks, but he did. That caused the HCI share price to rally about 20% in December, which cut my annual loss in the stock to minus 2.33%. Not a profit, but it was a lot worse until it got a lot better. And then KAL Group, at one point in the year, was down 25% as the interim results released in March and on Sens in May were actually dismal, down 4%, and the share price basically sank like a stone, hitting about 36 rand in early September. I was of another opinion. I've covered the stock for 2 decades. I've owned it myself for 2 decades. It's one of those stocks in my portfolio which I have said consistently I will never sell. It's just a well-run business, hopefully generating significant dividends in the years to come. A perfect pension fund portfolio. In the second half of the year, it had a fantastic rebound. And on the 26th of September, I initiated a note stating I expected very strong results for the year end. And when results were released at the end of September, they came in at the upper end of expectations, beating the last blockbuster result, I think, in 2023. And the share price ran about 25% in a matter of weeks. And for the year, it turned to me 5.7%. So overall, I was very happy that 7 of the top 10 did well, but 2 of the 10 actually rallied very hard towards the end of the year, just giving me slightly better news. But one, cash build, was my underlying nemesis. But as I said, to get a return of 16.15% from a basket of small cap shares which were not aligned to gold, platinum, or any offshore blue chip diversification or tech, I think was a fairly okay scenario. So I'm now going to move on to my top stocks of 2026, which is why you are all here. Pregnant pause for a sip of juice. The 15-page note went out early this week. So this Rand Swiss webinar is very well timed. I'd like to thank Gary Boysons and his team for organizing this, and Pascal, as always, for being the elegant lady behind the scenes, managing all the technology. As a reminder, if anyone has any questions to ask, there is a Q&A chat box. Please feel free to ask your questions. And I'm aiming to keep some time at the end of this webinar, which will end at 7:30, to answer any pressing questions if time allows. So I do 4 presentations here to Rand Swiss, and this is the first, and I always monitor my performance on a month-by-month basis. And for those that do not follow me in my social media account on X or Twitter, it's at Small Talk Daily, and I publish on a fairly consistent basis my opinions, and on a monthly basis the performance of my top stocks, so you can track how well I'm doing or not how well I'm doing. So the top stocks of this year are as follows. ADvTech, rolled over from last year. Afrimat, Argent Industrial, Copper 360, KAL Group or Corp Agri, rolled over for the 4th consecutive year. I'll tell you why in a short while. Motus, Premier Group, a stock that I chose in 2024, which has done spectacularly well, and I'm choosing it again this year. Rainbow Chickens, a rollover from last year, which I expect to have another very succulent set of results and dividend flow this year. Reunert, again a stock I had in 2024, which performed extremely well but fell off a cliff in 2025. And I'm expecting a resurgence in the underlying prospects in 2026. And lastly, a stock that again I've covered for many, many years, which many of you on this webinar will know and maybe own, which is Sabcap, the investment holding company owned by Seabrook, or Christopher Seabrook, I may say. I have chosen the stock again many times in the past, and it's been a fantastic performer, but I think the underlying prospects this year necessitate its inclusion. Now, as a bit of a basic background, all of these stocks were chosen in December and then refined at the end of December into the first day or two of January. And I actually consummated the list on the 2nd of January, which is when all of my prices were cast in stone. This competition is a 12-month scenario. I cannot change anything. Even if in my normal fundamental works, my recommendations change, I have to keep the recommendations as they are because that's the discipline of this competition I set myself, and I've been doing it now for many, many years. The other thing I want to say is that they were all chosen for a specific reason. I have a wide variety of institutional clients, traditional pension funds, hedge funds, family wealth offices, and individual wealthy clients. So I can't just choose a basket of stocks that would be not out of place in a casino. I have to choose stocks that are liquid, blue chip, in their mid-cap scenario for the larger funds so that they can buy them. There's no point in putting in a small cap stock with a tiny market value if a likes of an Allen Gray or a Coronation can't buy them. Similarly, I have to put in small cap stocks so the small cap funds would follow me because that's their mandate. And I sprinkle it in with a selection of special situations and the occasional wild card. Now, the wild card is a stock which I put in. It's not suitable for widows and orphans. It's not for Granny's pension fund. It's not where you take your housekeeping money and say, I'm not buying food this week, I'm going to buy it. It is a pure punt. It is a balls to the wall, black or red, an outside placement at the Kenilworth Racecourse scenario. In the last few years, I've had Nampak in twice, which has performed exceptionally well for me. And last year's another wild card I had was Libstar, which also performed exceptionally well. So my wild card track record has actually been quite good. So will this year's wild card of Copper 360 fare? I do not know, but I'll get to it fairly shortly. I'm going to run through these fairly briefly. I'm going to keep an eye on the time. It is coming up to 6:45. I aim to get all of these done hopefully in about 35 minutes and then leave at least 10 minutes for Q&A. So once again, get into the chat box if you have any specific queries. Pascal has given me some questions that people have emailed to her, and I will address those in the presentation. And just a couple of shout outs. I was telling Pascal earlier, I had a gentleman come to my new house earlier to sort out my saltwater chlorinator because I'm not technologically advanced. And he said to me, "Are you Anthony Clark?" I said, "Yes." "Why?" He goes, "My name's Chris. I'm sorting out your pool. And I'm listening to your presentation later." I said, "Well, hello, Chris. You now have met the person behind the voice." And then a friend of mine called Pierre Jacobs, who's also in Gansbaar, who may be back in Blauberg, is also listening in. And he's also sent a question regarding Argent, which I shall answer towards the end of his webinar. Moving on to ADvTech, why have I included it for the second successive year? Last year, it performed well. It was up about 17% total return. You know that Stargeo has been my preferred long-term choice in education for many years. It performed excellently last year, I think up over 60%. But the price earnings ratio for Stargeo right now, I think, is about 44 times compared to 18 for ADvTech. Now, granted, Stargeo does have a significantly better earnings profile and growth trajectory than ADvTech because of the stage of its development. Its giant new Durbanville campus opened on the 1st of January, and it opened with over 1,000 learners. And I'm expecting both ADvTech and Stargeo have very good trading updates for their December year ends. Now that Curro is basically vanishing into the ether, given it's been procured by Yanni Bouton's Educational Trust. And I wish him and Curro well in their new non-profit endeavors. But education is an area that I've covered for many, many years, and it's an area that is profitable if you catch the companies right. Stargeo has been a fantastic performer of mine for many years, and ADvTech, I think, is playing slow catch-up. Now, ADvTech has schooling in this country. It also has schooling into Africa, a growing element of tertiary and schooling in Africa, and of course, tertiary in this country with brands such as Varsity College and Rosebank College. In schooling, it has Abbott's, Trinity House, and of course, Crawford College. I'm expecting the stock to have another reasonable set of results, probably between 16 and 20% growth. But the real kicker to this company is coming from Africa, where it's expanding its footprint in Botswana, Ghana, Ethiopia, and new territories, not just in schooling, but also in tertiary education. And the learners there paying dollars, and the margins tend to be higher. So I'm anticipating that the underlying trajectory in ADvTech will continue, and the differential in rating will appeal to those looking for value or perceived value in the sector, given it should unwind to about a 15 or a 16 in the coming months as the trading update and results to December are disseminated by the marketplace. Now, I have nothing against Stargeo, but when I see a stock priced to perfection, I have to consider the risks to myself as an analyst and also the funds that I advise. And whilst the stock has hit new 52-week highs, when perfection is priced into the stock, if anything comes along to upset the apple cart, the stock gets smacked. I'm not saying anything is coming along, but I'm just raising the risk tolerance in Stargeo, and I'd much prefer to have ADvTech in my portfolio. If it gives me another 17 to 20% return this year, I will be very happy. Hence why I've chosen ADvTech. And because it's a 20 billion rand market value business, if the emerging market flows, which many are predicting will start hitting the likes of South Africa and other emerging markets this year from foreign funds looking to diversify out of the United States, given the weak dollar, then perhaps the bigger liquid blue chip mid caps may attract interest from foreign funds. and ADvTech is certainly one of those, given it's very well known with touch points that many international investors would like. My second call is Afrimat, a stock that I've covered for, oh gosh, now 21 years, I think, since it's listed on the JSE. Or shall I say, I think it's 21 years, I think from memory. Although I'm getting a bit old, so my memory may be fading. Last year was Afrimat's terrible, terrible year. It was its annus horribilis, its black swan event. Everything that could have gone wrong went wrong, much of it not its fault. When ArcelorMittal issued a force majeure in Q1, Q2 last year, saying it was not taking any iron ore domestically because of problems with its furnaces and its operations, Afrimat was hit. They had no choice, they could not supply. When the Mozambican election last year went pear-shaped and there was violence in the country and the borders were slammed shut, they couldn't export their anthracite from their mines in Mpumalanga to Maputo port because the borders were closed. And then the Lafarge transaction, which they procured or bought in May 2023, took nearly a year for the Competition Commission to actually settle. And that came in April 2024, and it was a mess. The plant was basically left to fend for itself, and it took Afrimat nearly a year and a half to turn that company around. But in the meanwhile, there were significant losses from cement of circa 300 million rand, even though the Lafarge aggregates business was performing exceptionally well. So you factor in the losses from cement, the inability to export anthracite, and the force majeure in iron ore, yet another strong rand, which hindered the iron ore price in the translation benefit on exports, and Afrimat's earnings were nailed to the floor. They fell nearly 90%, and the share price fell from 72 rand down to 36. Now, I revisited this stock at about 38 rand, and it's now at about 41, 42. I'm anticipating the second half recovery of Afrimat. We already saw the interim results to August, so a 90% increase in HEPS, albeit from a very, very low base. The global iron ore price is ticking up quite nicely. It's at its highest level since 2022, on ongoing hopes that the Chinese economy will be stimulated to stop unrest from the consumers there. We also have ongoing recovery in the cement business. The company is very confident that a near 300 million rand loss will be at break even this year. The construction materials business is doing quite well. And given that the ports in Maputo have reopened, and we may have seen the trading update from Grindrod the other day of record volumes going through the port of Maputo, I'm expecting the Unkamati anthracite to also start picking up, and at least 5 vessels to hit the export market again, bringing some nice revenue in for the company. It's a February year end. I'm expecting earnings of between 2.50 rand and 3 rand for the year, which still puts the price earnings ratio at the upper end of the range. But into the second half, if the expected recovery, as I mentioned, in cement, anthracite, and the ongoing demand for construction materials, amongst other issues, play in its favor, Afrimat should start to recover. There are 2 impediments which need to be considered. One is the stronger rand, which has shaved quite a bit of the benefit of the stronger iron ore price off the translation benefits. And secondly, Afrimat is stuffed full of debt, 1.6 billion rand, which will not have been reduced that much to the year end because they were restructuring the business to get the operations up and running. They need to start addressing that debt in the new financial year, just to keep the market sweet. And it's certainly something to keep an eye on. So Afrimat to me at about 41, 42 rand is one I believe could easily get into the late 40s, early 50s. And my target price on the stock is 54 rand. But again, many elements in this pie have to come together to make a juicy dish. And I'm hoping that Andres van Heerden and his team, if you're listening, will deliver. My next stock is one that is very well known to some of you out there, Argent Industrial. It's one of the very few small caps that have been a 10-bagger for those that have followed the recommendation. And I first had to buy the stock back in May 2019, having spent a day with CEO Treve Henry and Umschlanger dissecting the restructured and revitalized business. When I first encountered Argent at that point in March 2019, it was trading at 3.52 rand. When my first note went out, or my revised note in May, it was trading at about 4 Rand 54 from memory. It recently had a high of 36 Rand and is now trading at about 33 or 44 Rand. Now, this is a company that has had 15 consecutive periods of increasing earnings, dividends, and share buybacks. And the price earnings ratio, based on my forecast to a March 2026 year end of earnings of around 5 Rand 45, is a price earnings ratio of 6. Now, I cover many companies in the small to mid cap universe in industrial stocks, and I do not cover many companies that have had such a consistent track record in earnings and dividend growth and only trade on a PE of 6. Now, granted, its market cap is quite small, 1.8 billion, and it has very few mainstream institutional shareholders. And the company may not be, the flavor of the month to most institutions because of the entrepreneurial nature of management. But you've missed out on a stock that has delivered 1,000% return, give or take, in the best part of 7 to 8 years. And I'm expecting that growth to continue, not just this year, but next year. So every single target I have set on Argent has been attained and exceeded. And I recently upgraded my target to 38 Rand and ultimately 45. So Argent to me as a small cap gem for those looking for some spice in long-term growth portfolios with a small cap bent. Argent is one that I would tuck away. I do not believe that earnings this year or next year will disappoint. They're also sitting on about 600 million Rand of net cash offshore. They've got cash domestically. They're looking at deals. And as I said, about a third of their market value is in cold hard cash. So strip out the cash and we're trading at a P of around 4 or less, which to me is undeservedly cheap. So to me, it is another consistent buy, which is why I put Argent Industrial in. I think it'll perform at least 20%, if not more, this year. Now, my wild card, complete balls to the wall, not for Granny's pension fund, is Copper 360. I do not claim to be a geologist or a mining analyst or a mining expert, but I do have a top rating in the Financial Mail Analyst Awards in small cap resources, probably for my work on Afrimat, amongst other things. But we all know globally copper is flavor of not just a month, but of the year. We've got a number of scenarios where the demand for copper for the build out of artificial intelligence, data centers, the upgrade of electric networks globally, and of course the demand for renewable energy and EVs has seen a surge in the demand of copper. And that is going to lead to a major deficit globally because it takes 10 to 15 years to bring a major copper mine up to full production. So all the research that I've read, and I'm sure many of you have seen, not just online, but in the newspapers and in broker research, amongst others, indicate that copper is going to be in demand for quite some time. And it recently hit $13,000 a ton. Now, granted, President Trump is playing around in the copper market, but we have seen in the last few weeks some major transactions in the copper market. We've had Anglo American do a deal with Teck to combine their copper assets into a major global player. But in the last couple of weeks, Glencore made overturns to Rio Tinto to combine their operations to again amalgamate their global copper interests. Now, Copper 360 has disappointed the market since its listing. It soared on its listing and then literally fell in a heap as copper went green and turned rusty. The share price sank to over 46 cents in November, and the company then had a 1.15 billion Rand rights issue to raise equity to fund its expansion and production of copper and to restructure its debt. Now, 2025 was a year that many Copper 360 shareholders would like to forget. The share price basically died, and all the promises that management made regarding, yes, we will produce copper, yes, it's coming, basically fell in a heap. It was, we can produce copper, to no, we can't, it's coming. So 2026 better be the year, if the company is listening, that they start producing, or the faith that many have in Copper 360 will evaporate and it'll just tarnish. So I've put it in because copper is flavor of the month. And between Jubilee Metals, which is an AIM-listed and a JSE-listed company, I just felt there was more leverage in Copper 360 because it's either going to make a great deal of money on the upside or it's going to go bust. So as I'm saying, it's one of those stocks that you put some gambling money in, but the underlying fundamentals for copper remain solid. The question is, can Copper 360 actually deliver on the market fundamentals from its tailings operation? This will be the make or break year. My next stop is well known to many. It's KAL Group Corp Agri. In 2023, it was up 33%. In 2024, it was up 36%. In 2025, having been down 25%, it ended up 5.66% for reasons that I mentioned earlier. A very weak first half, a stronger second half, and record earnings that were delivered to September 2025. The management indicated that the agricultural sector is extremely buoyant because of all the rains we've had, and the fruit sector is performing exceptionally well. We've also had an uplift in the underlying demand for fuel because KL has a nationwide network of fuel outlets via PEG in over 100 outlets nationwide. And with passenger car sales increasing, we've seen those NAMSA stats tick higher month by month. There's greater demand for petrol. And that's where CARP makes some of its money, but it makes most of its money by people popping into the convenience stores of the fuel outlets and buying cigarettes and pies and Coke and groceries and Woolworths and Wimpy, etc., etc. And that is performing quite well. There are some elements in the company that will improve in the next 12 months. Roadworks in Natal, which hindered some of its projects and its locations, will come back on stream, again aiding the sales. And some new licenses which were delayed last year due to the regulatory issue regarding dealing with the government. We all know the government couldn't basically run a BOF, yet alone administer licenses for an important sector like fuel, and late licenses cost KL money. Those licenses are now in play and should start to deliver profits this year. So I'm expecting from a reasonable base year of R6.20, the company to earn this year, I'm getting between 7.30 and 7.40 cents. The price earnings ratio around 7 to me for a well-run hybrid in the convenience store, retail and agricultural space, I think is a very solid play. So I've put KAL in again for the fourth consecutive year, hoping that my faith last year, which was not fully delivered, will be delivered this year and I'll generate the returns. The valuation is certainly there. And the annual general meeting, which is happening in early February, I believe will deliver a very robust trading statement to the market. Motus has gone in. For the same vein, I put in CMH last year. Motus is a 20 billion rand large liquid mid-cap. Again, could attract the attention of emerging market players. But as I said earlier, with KAL and new car sales, it has leading distribution brands in Hyundai, Kia, and Renault, and a slew of brands amongst the Chinese, Indian, and other well-known marques that consumers like to buy. Now, we all know that consumers have been trading down, and some of the best value cars currently that are selling like hotcakes are Suzuki, Chery, JQ, Haval, GWM, amongst other brands. And Motus does have some of those in its stable, but to compete, it has recently gained the exclusive franchise for Tata Motors, where you can buy a cheap and cheerful vehicle for under 200,000 Rand, should you so wish. And as such, that is their competitive angle to try and compete against the Chinese, which, as the Business Day headline last week indicated, is now 15% of the total new car market in this country and growing. So I put CMH out, despite the fact that year to date last year it was up 18%, because it has a net cash position. So as interest rates fall in this country, it'll make less money on its net cash, whereas Motus is stuffed with debt. And one of the main elements that caused earnings to bump up last year was a lower finance costs. So this year, with new car sales picking up, new franchise models in lower value cars, and hopefully an ongoing decline in interest rates, leading to lower finance costs alongside potential emerging market interests. And if you check the Motus share price, it's been motoring up quite nicely recently, excuse a pun, trying to break a new 52-week high. I think the stock wants to move higher. So I've put Motus in because I think a number of touch points in the fundamental space should aid the company if my scenario, given what I've just painted, pans out. So I've put Motus in. Again, it plays in the space where some of my larger clients want to have large liquid mid caps in order to invest. Premier Group is in the same aim. It's a large J357 food producer, and it's a stock that I chose in 2024 at 62 Rand, and it returned 122% in the first year. And since my selection in January 2024, it's now up 190%. So you're probably thinking to yourselves, why is Anthony choosing Premier again at about 170, 180 Rand, given it's already up nearly 190%? The answer is there's more to come, a lot more. Late last year, the company not only confirmed to the market that its annual underlying growth in headline earnings per share will be maintained in the 25 to 30% growth range for the next 12 to 18 months. They then also made a bid to buy RFG Group, Rhodes Foods Group, which was in my top stocks of last year and was up 27%, bringing in the stable of Rhodes products from their fruit juices to their jams, to their Bull brand range of meats, to their ready meals to Woolworths, their Heinz spices, amongst others, into the greater platform of Premier Group. Now, the reason I'm very excited about this is quite manifest. One, putting two food companies together will generate costs. There'll be duplication of costs that will be cut. Head office costs, banking costs, insurance savings, finance costs, logistics, supply chain distribution, etc., etc., etc. I estimate in the first year the cost savings on this combined entity will be 150 million Rand. Also, Rhodes as a smaller company had a constrained balance sheet. Given that Premier has a much, much larger balance sheet, given its market value and the scale of its ability to write checks, Rhodes had an inability to actually follow through by actually investing in all the growth touch points at once in its portfolio. Premier have the ability and the money in the sofa to do that. So I expect significant checks to be written to expand the production and utilization of Heinz spices, of the ready meals business, and of course juices with new product offerings and new formats. Premier can do that, and it can push the Rhodes Foods products through a significantly larger customer base. So as a combination of 1 plus 1 does not make 2, 1 plus 1 in this case makes 3. Premier is a very well-run bread business with a confectionery arm and an offshore business based in the UK. And adding the Rhodes business in just augments the grocery basket and allows it new touch points to reach more consumers. And as I've constantly said, Premier's management, I believe, is one of the best in the marketplace. No disrespect to Shard Kruger at Tiger Brands and my dear friend Simon Crutchley at AVI, but Premier are a class act. And the results of the last 2 years have proven that, and I believe it'll continue this year. And my target price in Premier is 230 Rand and ultimately 265. I expect the earnings momentum in this company on the back of its existing operations, its expansion of its bread business with Ayrton mega bakeries coming on stream, and the Rhodes business coming online will kickstart and accelerate the earnings growth of Premier. And I think the price earnings ratio, which might seem quite rich currently, will unwind quite quickly. Again, a large quality mid-cap blue chip stock will attract not just pension funds and the emerging market players, but anyone looking to build a solid, consistent, small to mid-cap growth portfolio going forward. Moving on to Rainbow Chickens, again, a stock I rolled over from last year. Last year, the stock was up 33%. And it paid a dividend of 20 cents, which was a year ahead of schedule. This is a company where the tailwinds are in its favor. The soya price and the yellow maize price have fallen materially on a one-year basis. And soya and maize are the main cost of rearing a chicken for slaughter. Between 60 and 70% of the cost of rearing a bird is inputs. And yellow maize is down about 38% year to date, and soya 28%. We also have fuel costs coming down, so the distribution cost is quite low, and those still running generators in the hinterland, where the ANC-run municipalities continue to be a complete disaster, will see lower generator costs. Astral Foods, as an example, still spends 10 million rand a month on diesel to power its generators, despite the fact that Eskom load shedding has ended. It has not ended in parts of the country where the ANC still run a shit show. So diesel costs should help many food companies going forward if they operate in the hinterlands of this country. I expect Rainbow to have succulent earnings for the trading update I'm expecting for their December half-year period, which should be out sometime in late February, early March. And they are awash with cash. They have a gravy boat full of money. And having paid a dividend a year early last year, I expect them to be under pressure this year to pay even larger dividends or even a special. So if CEO Martinez Stander is listening, Martinez, I want my dividends and a big juicy chicken drumstick of earnings. And I think he's going to deliver. Even though the stock underperformed Astral last year on a valuation basis, it was on a 7.4 versus Astral's 12. Astral is a great company. My target value is about 250 for Astral. Sorry, it was 250. It's now been moved to 320. Rainbow is 650, and I see more growth in Rainbow going forward based on earnings momentum and the ability to pay fat dividends. My last two are Reunert, a stock that I chose in 2024 for the same reasons I'm choosing it today. Back in 2024, all the touch points were in its favor. They have a cabling business which provides copper cables to the municipalities and to Eskom and into industry. But we had very high hopes that the GNU would roll out electrification and an upgrade to the crumbling infrastructure network in this country. And of course, it never really happened. We all know the ANC could not even tie their shoelaces. So the spend never really happened. And as such, Reunert's factories were running at around 70% utilization. In the meantime, the copper boom in Zambia, where they have an operation, saw their interests in that country pick up quite nicely. But we need infrastructure investments in South Africa, particularly in cabling infrastructure, for Reunert to actually perform in that element. Other assets inside Reunert should also do quite well. Their circuit breaker business has won substantial new orders in the United States, despite the Trump tariffs, where they actually compete effectively against international competitors. Reunert's defense business has an order book of 2.5 billion rand and growing, with material orders in the Middle East and some timing issues last year, which caused earnings to have a bit of a hiccup. But sadly, even though war is a terrible blight on humanity, we all know that war is very profitable for defense companies. We've seen across the world defense company shares boom in 2025 as bombs drop and war ensues in varying geographies across the world. And Reunert has benefited, particularly in an uplift in communication technology in the Middle East, and should continue to do so. But one of my main picks of Reunert this year is the fact there's a management change happening in the next couple of months, where the long-standing CEO, Alan Dixon, who's been an incumbent of Reunert for many, many years, and who's left the company in a very strong balance sheet position for the new heir apparent, has seen the board choose an external candidate to become the new Reunert CEO, breaking something that it's done for the last 40 years of choosing insiders. They've chosen a gentleman called Antonie de Beer, who's the former CEO of Ethos Private Equity. Now, we all know that private equity are a bit like vultures. They are adept at looking for carcasses to either try and fatten up to sell, or businesses that perhaps have been ineffectually managed, where the assets are undervalued, where they can either bulk up the assets to sell or bulk them up to make more profit. So I'm hoping that when Mr. De Beer comes in and starts casting his beady private equity eye over Reunert, he sees a business with some really interesting touch points where value could either be upgraded or basically extracted by either a joint venture or potentially even a sale to a party to unlock value to shareholders. So about 62 Rand on a price earnings ratio of under 10 and a dividend yield of 6.2%. Reunert to me has a number of very interesting touch points, not just in the hoped ability of a GNU to invest in infrastructure in this country, but in the ongoing global conflict and the underlying promise that a new management team will hopefully shake the tree at the erstwhile defense electronics and copper business. I have high hopes for Reunert in 2026. Let's wait and see. It was a good stock for me in 2024. My last stock is the investment holding company run by Christopher Seabrook, the extremely well-regarded and erstwhile entrepreneur of Sabvest Capital, is a stock that I've consistently recommended in my investment research for many, many years, and I own the stock myself. And just as a caveat, as I published in my notes, I do own Afrimat, KAL Group, Sabcap, and Argent Industrial personally, and I have done for quite some time. So I'm not just talking my book. I put my money where my mouth is, and I've owned many of those stocks for many, many, many years. Sabcap is one that I first invested in at 28 Rand and is now at about 125 Rand. The net asset value, given the trading update that was issued for its year-end December 2025, places the stock at a discount of around 23%, based on a midpoint net asset value to December of 160 Rand 41 cents. Now, Sabcap for many years produced net asset value growth of between 9 to 12% per annum. But in portfolio restructuring, asset sales, debt restructuring, it's now got a very strong balance sheet, and new management implemented at some of the large assets like DNI 4PL and the international labeling business ITL. There's been an improvement of the underlying profitability and as such valuations of the companies held in the unlisted portfolio. Many of the listed assets have been sold, and the only remaining listed asset is Career Networks, the security company listed on AIM, which this week had a very upbeat trading update for its first half, and the share price has perked up quite nicely. But given the Rand volatility, still is down year on year in the Sabcap portfolio, but it's very small in the mix. Its largest assets, which is SA Bias, which is in trimmings and exports, DNI 4PL in communications and telecoms and prepaid networks, ITL in labeling, amongst others. The top four assets comprise 70% of the Sabcap NAV. And one of the largest assets, which is growing exceptionally fast, is Apex Partners, the industrial arm of Sabcap, run by entrepreneur Charles Pettit. The valuation is currently just shy of 900 million Rand. And the initial valuation when it entered the Sabcap portfolio about 7 years ago was 90 million Rand. So it's gone up 10 times in the space of 7 years. They've just concluded a very large transaction to buy DRA Global, a global mining services company, which will be dovetailed into the ELB Bateman business they already own. And as such, I expect the Apex Capital Partners valuation uplift to be quite material in the next 12 months to between 1.2 to 1.4 billion Rand, which alongside ongoing profitability growth and potential for DNI 4PL and ITL, amongst other investments, should see the net asset value in Sabcap continue to grow between 15 and 25% per annum. That has been the case for the last 12 months, and I have no doubt that the net asset value this year to June 2026, to December 2026, and June 2027 will follow that trait. So my valuation for Sabcap is 165 Rand, my immediate target, then 180 and 240 in the tail end of 2027. Aggressive growth targets supported by net asset value growth. So again, a stock for consistent performance and a stock that any small or mid-cap growth fund can happily own, sit back and sleep at night. Often in a portfolio, you have to have stocks that perhaps may not be as glamorous as Copper 360 or as risky, but give you consistent performance, particularly when the entrepreneur concerned is a material shareholder in the underlying business of which Seabrook actually is. So that's the top stocks. And reminder, excuse me, it is ADvTech, Afrimat, Argent Industrial, Copper 360, KAL Group, Motus, Premier Group, Rainbow Chickens, Reunert, and Sabcap. And let me take a sip because my throat is getting a bit dry. It is coming up to 20 past 7. I will check the chat box and I will answer the first question. Pierre Jacobs asked me, what is the percentage of earnings that Argent Industrial generates from offshore? Revenue is around 32% from memory, and earnings is around 70%. And that has been growing. Treve Henry is currently running around the world. He's in Canada, United States, Dubai, India, amongst other places, looking for transactions. And I continue to believe that the company will recycle any cash it generates from asset sales in this country and will only invest it offshore. And if they do buy companies in this country, it'll only be in businesses where the product concerned can be manufactured in this country and then exported into a hard currency environment. So going forward, I expect Argent's percentage of earnings to come from offshore to keep on growing as the domestic asset base is shrunk and the assets are recycled into European and North American jurisdictions. Let me have a look at the question here. Let me flick on through. If there's any commonality, I will just group them all together. I've just discussed Argent. I've discussed RFG. Would you not buy RFG rather than Premier? Do you think the deal is not guaranteed? Well, I think the deal is going to go ahead. Premier believe that the deal should be consummated by the end of March. Now, we all know the Competition Commission are a bunch of socialists, so it may or may not happen at that time, but management are very confident there is no overlap. And the rally in RFG share price and Premier is clearly indicating the market believes the deal will actually go through. So if a deal were to fall through, I would still only want to own Premier. I wouldn't want to own RFG Group. Good question. Would I take profits in Stadio or just continue to hold? As I've said earlier, it's one of the stocks that I have said consistently. If I only wanted to own one stock in the private education longer term, it would be Stadio. I own Stadio PA. I am not a seller, but I would not be chasing the stock at 14 Rand. You could have bought this stock a couple of years ago under 5 Rand. We're now at 14. And I hate chasing stocks when the easy money has been made. Yes, it has good growth, but I think much of the growth is priced in. And I think the growth from this level in terms of a share price will start to decelerate. And as I said, given the price earnings ratio and the price to perfection ratio at 44 times versus ADvTech's 18, I cannot advocate buying Stadio at the current levels because, as I said, the easy money has been made. I'm looking at questions here on the fishing sector. I actually have a note going out tomorrow morning on Oceana, Sea Harvest, and Brimstone. Many of you will have seen that Oceana basically saw a transaction where Brimstone sold 9.2% of its stake to a Dutch-based consortium. That was done at 53 Rand a share for 633 million Rand, enabling Brimstone to bring down its debt from 1.754 million to 1.2 billion. Good for all parties. Brimstone owns a 16% stake. Under the terms of a transaction, if they do sell any more shares in the next 12 months, the Dutch-based buyers have first right of refusal. So I ultimately have said in many notes, the last one dated May 2023, that I believe that ultimately Brimstone will sell or unbundle its Oceana stake, repay all its debt, and then as such just unwind itself, and all that will be remaining is Sea Harvest. I still believe that, so I think that Oceana, as it stands right now, could be a very interesting corporate play for the next 12 months. Just my opinion. As always, do your own research. Sea Harvest has had a fantastic trading update. I've had two or three upgrades, having had 4 years of terrible fishing. Earnings this year are around £1.65. The price earnings ratio has materially unwound, and dividends should resume healthily to help Brimstone, its largest shareholder, keep the lights on and to repay its own finance costs. I think Sea Harvest CEO Felix Rateb has done a fantastic job. They've sold off Ladysmith Cheese for 800 million rand to repay debt, to make the balance sheet slightly stronger. And if wild catch rates continues to remain on the hook, Sea Harvest for the next reporting period should have a fairly good period. I think the stock is undervalued, but it's not a stock for everybody because it has let you down badly over the last few years, and the current season is looking very good. But like agriculture, fishing is cyclical. So it's good currently. It may not last forever. But as it stands right now at about £9.40, I think that Sea Harvest and Oceana look like very interesting buys in the sector. Question from Mohammed on do I see the retreat in CA sales as being a potential buying opportunity? The answer is potentially yes. But the caveat is, as I wrote in a note May last year, 50% of CA sales revenue is derived from Botswana. And the Botswanan economy, given it's a diamond-led economy, was performing poorly. Government finances were a bit ropey. There was a change of political persuasion in government towards the more socialist element, looking to bring in a number of quite business unfriendly policies, which would increase their operating costs. And that may lead to a slowdown in the Botswanan economy. Now, Duncan Lewis, the CEO of CA Sales, was confident that Botswana would produce growth this year of around 8%. We do have a trading update hopefully coming out, or a business update in the next month or two, given the December reporting period. So as it stands right now, I think that CA Sales looks interesting, but I'd like to get sight to see how sales have done in Botswana first before I went in with a new purchase. So my advice to you is keep it on your watch screen. And if you see the trading update indicating that Botswana was not as bad as market fears, then I certainly would be buying the stock. It's a stock that I have owned for many, many years. I'm heavily overweight for stock in my personal portfolio, excuse me. And I think on any weakness, and if Botswana is seen to be not as bad as expectations, I would be looking at accumulating the stock at around the current levels. Let me scroll down for any more questions coming in. There are lots and lots and lots and lots. I don't cover technology stocks. I have no view on Optasia or any other technology stocks for those that have asked questions. I have no opinion on Jubilee Metals. All I know is what I posted on my X account, that the sale of their PGM assets and chrome assets have been completed. The funds are now hitting its account. It's now a pure copper play, and it needs to get those copper operations in Zambia operating efficiently. And again, as I said, regarding Copper 360, at least Jubilee Metals is producing copper, although there has been some issues in Zambia hindering its performance. But hopefully with PGMs out of the way, which perhaps is now an unfortunate situation, given the rally in PGMs, but at least the copper play hopefully may attract attention. Not a stock that I formally cover. It's dual listed in London and on the JSE, but I have regularly posted comments from the Investors Chronicle, which is the leading UK financial magazine which commentates regularly on Jubilee Metals. So scroll my Twitter page at Small Talk Daily for recent comments on Jubilee Metals. A question on HCI, given the discounted net asset value remains over 50%, although we have seen Johnny Copeland sell off assets, as I mentioned, in shopping malls and property to reduce debt and buy back shares, and he's locked in his unions, who were consistently selling the stock and depressing the share price. So in theory, HCI should look better if assets are unlocked and property worth 1.2 billion rand is sold, and they've so far raised with their stakes in varying assets, probably around 800 million rand from their varying stakes in the Sea Point property and the Hermanus Whale Route Mall. There may be more to come, but a large element of HCI's potential value is tied into oil and gas exploration assets off the coast of this country and, of course, the Venus operation operated by Total Energy and its partners off the coast of Namibia. Now, we all know that President Trump wants oil to be lower so that the American consumer has more money in their pockets. Invading Venezuela was an oil situation, and the West Texas Intermediate price and the Brent crude oil price have recently fallen to low levels, which means that will Total Energy give the commitment to actually explore the Venus well and the enormous multi-billion-dollar capital cost that'll have, given that oil is sitting at $60 a barrel or lower on an international basis. So HCI indicated they are waiting Total Energy to indicate if they will approve the vast transaction in exploring and bringing to production the Venus wells, which is one of the largest new exploration sites discovered in many years. And production, if it occurs, should happen by 2029 or 2030. And as such, then HCI will start to recoup its dividends, repay its loan to Total Energy, and once the loan is repaid, could bring in circa $200 million a year in net dividends to HCI, but we're talking probably in 8 to 10 years' time. So as it stands right now, HCI is doing all the right things to try and keep the market and the activists happy, but there's still a significant element of a company tied to oil. And oil currently, as we all know, is not flavor of the month. I did consider putting HCI in my top stocks this year, but given what is going on with oil and Trump and Venezuela and Iran and who the hell knows what else geopolitically, I just thought it more prudent to leave it out. I own HCI myself. I'm not a seller. I'm not a buyer either, but I'm hanging on to see what is next from HCI, Johnny Copeland, and of course, oil. I'm now coming up to 7:30. I do not want to keep Pascal away from her home. So for myself, Anthony Clark, here in my new office in Romans Bay, I'd like to thank Gary Boysons and Pascal at Rand Swiss and the entire team for once again allowing me to present to their client base. I hope the presentation that I've given you on the review of the top stocks for 2025 and the key rationale as to why I chose the top 10 of 2026 is enlightening. Pascal tells me that a new segment going forward is she will take this 1 hour presentation, she will chop it into bite-sized segments on individual companies. So if you don't want to listen to Anthony prattling on about stocks you have no interest in, you can just listen in to, let's say, Reunert or Premier or Argent. So keep an eye on the Rand Swiss website and the Rand Swiss YouTube. And when those segments are uploaded in the coming days, I will also post them onto my X platform at Small Talk Daily. If you haven't followed me, feel free. I publish fairly consistently a number of opinions and I post my work, and it might be worth just having a look-see. Anyway, for myself, God bless, take care, have a wonderful Thursday evening, and I'll see you again in a quarter's time. Cheerio.